Tesla is not just a car company. That sentence alone is the reason this story matters. Because if Tesla were only about vehicles, production numbers, and profit margins, this video would be very short. But Tesla lives in a different category. It exists somewhere between technology, finance, ideology, and belief. And markets have always behaved strangely when belief becomes more valuable than reality. In traditional investing, companies are valued based on what they earn today and what they can reasonably earn tomorrow. Tesla broke that logic. For years, it was valued higher than automakers selling 10 times more cars, generating stable profits, and operating mature global supply chains. Yet Tesla's valuation continued to rise, often disconnected from its actual financial performance. Analysts tried to explain it with spreadsheets. Critics tried to expose it with ratios. But none of that slowed the momentum, because Tesla was no longer being priced as a company. It was being priced as a future. And the future is the most dangerous asset in finance. It cannot be audited, it cannot be verified, it can only be imagined. Tesla invited investors to imagine a world where cars drive themselves, energy is decentralized, and one company sits at the center of it all. Buying Tesla stock wasn't just a financial decision, it became a declaration, a statement that you understood where the world was going before everyone else did. This is where psychology replaces accounting. When enough people believe a story, price stops reflecting value and starts reflecting faith. Tesla's stock became a symbol of optimism, innovation, and rebellion against outdated systems. Doubting Tesla didn't just make you cautious, it made you look obsolete. And markets punish those who appear out of touch with the future. But history does not reward belief forever. Every technological revolution produces a moment where expectations outgrow reality. Railroads promised to reshape nations. The internet promised to rewrite commerce. Each delivered enormous change, but not without destroying companies that were priced as inevitabilities. Tesla now stands at that exact intersection. The question is no longer whether Tesla changed the auto industry. It clearly did. The real question is whether its valuation reflects transformation or illusion. Because here is the uncomfortable truth. Tesla's market value depends not on what it produces today, but on what it must successfully execute tomorrow, next year, and a decade from now. Any delay, any regulatory shift, any serious competitor, or any crack in confidence has outsized consequences. When expectations are absolute, reality has no room for error. Tesla does not need to fail to become dangerous for investors. It only needs to underperform its own myth. And myths are unforgiving. Once belief weakens, markets don't adjust gradually, they reprice violently. What looks like confidence on the way up often reveals itself as fragility on the way down. This story is not about hating Tesla. It is about understanding what kind of asset it really is. A car company can disappoint and recover. A belief-based valuation has no such safety net. Tesla asked the market to suspend disbelief and buy into a vision of total transformation. Millions did. Trillions followed. And now, Tesla exists in a space where success must be perfect, constant, and unquestionable. Anything less threatens the entire narrative. That is why Tesla is not just one of the most valuable companies in the world. It is one of the most exposed. Microhook. The moment belief becomes more valuable than profit, risk stops being visible. Tesla's rise was never just about selling electric cars. It was about selling inevitability. From the very beginning, Tesla positioned itself not as an alternative, but as the future itself. Traditional automakers were framed as relics of a dying era, while Tesla was presented as the only company brave enough to challenge the entire system. This framing mattered more than production numbers or profit margins, because markets reward confidence far more aggressively than caution. At the center of this narrative stood Elon Musk, not as a manager, but as a symbol. Musk was not marketed like a CEO, he was treated like a visionary architect of the future. Every public appearance, every tweet, every bold promise reinforced a simple idea. Tesla was not bound by conventional limits. Delays were reframed as ambition. Losses were reframed as investment. Criticism was reframed as ignorance. This allowed Tesla to operate under a different set of expectations than any other automaker in history. Timing played a critical role. Tesla's explosive growth coincided with an era of cheap money, low interest rates, and unprecedented liquidity. Investors were searching for the next transformational story after Apple, Amazon, and Google. Technology had already proven that dominant narratives could justify extreme valuations. Tesla became the next logical leap, but unlike software companies, Tesla was capital-intensive, operationally complex, and deeply exposed to supply chains, regulation, and manufacturing risk. Those realities were acknowledged, but rarely priced in. As Tesla's stock price began to rise, something unusual happened. The stock itself became proof of the story. Rising prices attracted media attention. Media attention attracted new investors. New investors pushed the price even higher. This feedback loop created momentum that fed on itself. Tesla stopped needing traditional marketing. The chart became the advertisement. Belief became contagious. Retail investors played a massive role in this phase. Tesla was not just owned, it was defended. Online communities formed around the stock, treating criticism as a personal attack. Short sellers became villains. Analysts who questioned valuation were dismissed as outdated or biased. The conversation shifted away from fundamentals and toward identity. Supporting Tesla meant supporting innovation, sustainability, and progress. Doubting it meant standing in the way of the future. Government policy added another layer of reinforcement. Environmental incentives, tax credits, and global climate initiatives aligned perfectly with Tesla's mission. This gave the company political and moral leverage that few corporations ever achieve. Tesla was no longer just a business. It was positioned as a solution to a global problem. That perception made its success feel necessary rather than optional. Internally, Tesla embraced this momentum. Aggressive expansion plans, bold timelines, and ambitious technological promises kept the narrative alive. Each new announcement extended the future further outward. Full self-driving, robotaxis, energy dominance, AI integration. Every promise expanded the scope of what investors believed they were buying into. The valuation was no longer about cars. It was about ecosystems, platforms, and total transformation. But this is where the myth quietly became fragile. Because myths require constant reinforcement. They demand uninterrupted progress. Any pause, any contradiction, any sign of limitation threatens the entire structure. Tesla's rise created a situation where success was not defined by improvement, but by perfection. The higher the expectations climbed, the narrower the margin for error became. Tesla's ascent was extraordinary, but it was built on a delicate balance between vision and execution. And history shows that when markets confuse vision with inevitability, the correction, when it comes, is rarely gentle. Macrohook. When a company becomes a symbol, reality eventually demands proof. Every myth eventually collides with reality. For Tesla, that collision did not arrive as a single catastrophic event, but as a series of quiet fractures that slowly began to challenge the narrative of inevitability. The company did not suddenly fail. Instead, it began to show signs of strain in the very areas that belief-based valuations tend to ignore: execution, consistency, and limits. One of the first pressure points was production. Scaling manufacturing is unforgiving. Unlike software, cars cannot be patched with updates or shipped digitally. They require factories, logistics, labor, and flawless coordination. Tesla's rapid expansion exposed this reality. Missed delivery targets, quality complaints, and supply chain disruptions became recurring themes. Each issue was explainable on its own, but together they formed a pattern that questioned whether Tesla could grow at the pace its valuation demanded. Competition also arrived faster than the narrative anticipated. Traditional automakers, once dismissed as obsolete, adapted, invested heavily in electric platforms, secured battery supply chains, and leveraged decades of manufacturing expertise. At the same time, new players emerged, particularly in China, offering competitive electric vehicles at aggressive prices. Tesla was no longer alone at the frontier. The market it once defined began to crowd. Regulation introduced another layer of complexity. Autonomous driving, one of Tesla's most powerful promises, faced scrutiny. Safety concerns, legal challenges, and regulatory investigations slowed the path to full self-driving adoption. What had been marketed as a near-term breakthrough began to look like a long-term, uncertain process. Each delay weakened the implied timelines baked into Tesla's valuation. Then there was pricing power. For years, Tesla benefited from demand that exceeded supply, but as competition increased and economic conditions tightened, Tesla was forced to cut prices. This move protected market share, but it pressured margins. In traditional valuation models, margins are a core pillar of long-term value. For a company priced as a premium technology leader, declining margins raised uncomfortable questions. Investor psychology began to shift subtly. The tone changed from celebration to defense. Positive news no longer fueled explosive rallies. Negative news began to matter more. Volatility increased. The stock reacted not just to results, but to expectations about expectations. When a company is priced for perfection, even excellence can disappoint. Elon Musk's role, once a pure asset, became more complicated. His influence across multiple ventures divided attention. Public controversies introduced unpredictability. For a company so closely tied to a single personality, any uncertainty around leadership amplified market risk. The myth required a flawless protagonist. Reality rarely provides one. Macroeconomic forces added pressure. Rising interest rates reduced appetite for speculative growth assets. Liquidity tightened. Investors became more selective. In this environment, stories without immediate cash flow lost some of their power. Tesla, still heavily dependent on future growth narratives, felt that shift more acutely than mature, cash-generating firms. None of these factors alone doomed Tesla, but together, they created a critical shift. The story was no longer uncontested. Doubt, once marginalized, began to sound reasonable. And in financial markets, doubt is not dangerous because it is loud. It is dangerous because it spreads quietly. That cracks did not mean collapse. But they changed the rules. Tesla was no longer judged only on its vision. It was increasingly judged on its ability to deliver quarter after quarter, under pressure. That transition is where many legendary growth stories either mature or break. Microhook. The moment a company must prove its myth, the market stops forgiving mistakes. Tesla now exists in a space few companies ever reach. It is no longer a startup, and it is not yet a stable industrial giant. It sits in between, carrying expectations from both worlds. Investors no longer ask whether Tesla will survive. They ask whether it can justify what the market has already decided it should become, and that distinction changes everything. A collapse does not require failure. It only requires disappointment. When a company is priced for extraordinary outcomes, delivering ordinary success can feel like betrayal. Tesla's future depends on whether it can turn vision into repeatable, defensible execution, not once, not occasionally, but consistently, across vehicles, software, energy, and emerging technologies. The bar is not high, it is absolute. The transformation case argues that Tesla is still early, that autonomous driving will mature, that energy storage will scale, that manufacturing efficiencies will unlock new margins. In this version of the story, Tesla evolves into a platform company, not just an automaker. Investors are not wrong. They are simply early. This narrative depends on time, patience, and uninterrupted innovation. It assumes Tesla continues to lead while competitors struggle to catch up. The opposing view is less dramatic but more unforgiving. It suggests Tesla becomes a very successful car company with strong technology, loyal customers, and meaningful profits, but not the dominant force the market once imagined. In this scenario, Tesla does not collapse, it normalizes. Valuations compress, expectations reset, returns become ordinary. Historically, markets punish this outcome far more than outright failure because it exposes how much of the price was built on hope rather than reality. Tesla's uniqueness amplifies both outcomes. Its brand, its community, and its cultural relevance give it resilience few companies possess. But those same qualities make it vulnerable to shifts in sentiment. Confidence can disappear faster than factories can be repurposed. Belief is liquid. Infrastructure is not. The role of Elon Musk remains central. Tesla's story is inseparable from his. As long as Musk symbolizes innovation and ambition, the narrative holds. If that symbolism weakens, the market will reevaluate not just leadership, but the entire thesis. This concentration of narrative power is both Tesla's greatest strength and its greatest risk. What makes Tesla truly dangerous as an investment is not volatility, it is ambiguity. The company operates at the intersection of technology, manufacturing, energy, and ideology. There is no clear precedent that makes traditional valuation tools inadequate and emotional conviction tempting. Investors must choose which uncertainty they are comfortable with, the risk of missing a transformation or the risk of overpaying for a myth. Tesla's story is still being written. It may redefine industries or simply redefine expectations, but regardless of outcome, Tesla has already delivered a lesson markets rarely learn willingly. The price of belief is not paid up front, it is paid when reality arrives. This is why Tesla matters. Not because of cars or charts, but because it reveals how modern markets think, feel, and sometimes forget the difference between vision and value. Whether Tesla becomes a historic triumph or a cautionary tale will depend less on innovation and more on execution under pressure. And in the end, markets do not reward dreams, they reward delivery. When the future finally arrives, only execution decides who was right.